time for Shale's loaners to settle down. While EQT Corp didn't do a stellar job of selling its $8.2 billion acquisition of Rice Energy Incorporated, its CEO did make a salient point about the future of America's shale basins on Monday's analyst call. It is my belief that we are in the second phase of the shale gas, I guess we call it, revolution. And the high growth models of the first phase, I don't think are going to work in phase 2. So, I think the way that will play out, particularly, after this acquisition, when we are now the largest producer in the US with a very attractive and concentrated position, is we will have to determine what the appropriate growth rate is. But that growth rate will likely be certainly within cash flow and most likely below our cash flow so that we can return cash to shareholders. The biggest selling point for this deal is that, by marrying up two contiguous positions in the center of the giant Marcellus shale gas basin, EQT will be able to drill more productive wells. The resulting drop in unit costs will help it withstand lower for longer natural gas prices. In a gas market glutted by the success of that first phase of the shale boom, the emphasis must shift from growth at any price, which just adds to the glut and burns capital, to balancing growth with at least the prospect of positive free cash flow. Investors in the E&P sector have heard similar sentiments on the oil side recently from the likes of Pioneer Natural Resources Co., all of which should excite one set of interested parties: oil bankers. U.S. shale has been a hot zone for M&A. There were 32 E&P deals worth $36.6 billion in the first quarter, according to a survey by PwC. Almost 4/5 of that deal volume related to the Marcellus, Utica, Eagle Ford and, especially, Permian shale basins. This has been a mixture of existing operators adding to their portfolios, other oil companies buying their way in, and private equity firms staking out positions. The renewed slump in oil prices as faith in OPEC's supply cuts has faltered, along with persistent weakness in the gas market, likely has something to do with a slowing of deals in shale prior to this week. However, EQT's deal, as well as several more announced on Monday by Occidental Petroleum Corp., suggest the impetus for consolidation remains intact. There remains plenty to do on this front. The chart below, courtesy of Artem Abramov, VP of Analysis at Rystad Energy, shows the number of operators drilling and completing at least one horizontal well in several major shale basins over the past decade or so. The shale patch work. While the crash in oil and gas prices forced some consolidation in U.S. shale basins, they remain quite fragmented. The Permian Shale stands out. In the core Delaware and Midland areas of the basin, the top 10 most active E&P companies account for only 53% and 55% of rigs in operation, respectively, according to Matt Haggerty of Bloomberg Intelligence. Those proportions have actually fallen from 60% or more at the start of 2015. All the basins look fragmented to some degree, though, including the Marcellus Shale, where EQT and Rice are getting together. Barring a sudden end, short of a war, unlikely surge in oil and gas prices, consolidation should pick up. For example, ExxonMobil Corp., having done a string of deals already in the Permian Shale, seems likely to be back for more as it seeks near-term development opportunities. More broadly, the need to squeeze further productivity gains out of shale as prices stay low is a powerful incentive to pool resources, balance sheets, and expertise, and cut costs. The same logic, and dismal price environment, drove the oil megamergers at the end of the 1990s. All of which raises an interesting question, both for shale and the global energy market. One of the outcomes of the dash for growth in U.S. shale, that first phase to which EQT's CEO was referring, was surging production. This inevitably led to excess supply, lower prices, and some financial distress. In theory, consolidation should temper growth, as per the EQT chief executive's comments. Bigger companies holding larger land positions tend to stagger their drilling, picking their spots and smoothing their investment over time, rather than going hell for leather. How far that theory holds in shale remains to be seen. However, the competitive dynamic in shale is very strong, given the dozens of companies involved, and the global, or globalizing, nature of the oil and gas markets. For example, merge the top 3 U.S. natural gas producers, including the newly minted EQT/Rice as one of them, and the resulting behemoth would still control only about 10% of U.S. output. More importantly, success in shale, especially in this price environment, is a function of reducing the cost of each barrel of oil or cubic foot of gas produced. That does mean being more selective with drilling. Mostly, though, it means boosting the production from each new drilling site via longer wells, more fracs, better data on geology, and any number of other techniques. The CEO of EOG Resources Incorporated hinted at this last month on an earnings call, saying the company didn't need to wait for oil prices to rise in order to drill, given improving economics and a large base of resources to tap. In this business, as in manufacturing, you learn, and thereby cut your costs, by doing.